just going to give it a minute to test out the video and give people a few more minutes to, or just maybe a minute. Thought there was a way to see everybody's names, but for some reason I'm not able to get that to show up. Let's see. Thanks for that, Brenda. Appreciate it. Guess that's where they show up. All right, excellent. All right. You can either do the long slide or the short slide. I think we're going to do the short slide here. If I can delete this here. Let's do that. All right, on one page. Okay. So what I wanted to talk about today is what I put in the teaser video, or the teaser tagline on the LinkedIn post was find out what Mike got wrong. And what it was that I got wrong was that in the Trump tax changes, there is some new legislation and new terminology and a lot of still yet to be defined definitions of the terms. And one of the terms is specified service, trade, or business, and it's being abbreviated as SSTB in the accounting literature and the various tax trade magazines and all that kind of stuff. And what it's, it almost sounds like a disease, some sort of STD, but it's SSTB, specified service, trade, or business. And what they're attempting to do is carve out or define certain industries or professions that if the business owner is earning above certain thresholds, the business owner will not be able to get the benefit of the 20% business pass-through expense. And the reason that's important, or the reason the definition is important, is that if you're in one of those targeted industries or targeted professions, and you're earning a substantial amount of money, I think it's $175,000 as a single person and $315 as a married couple, then you may be phased out of getting the 20% business expense deduction. So what I got wrong was who I included in that definition. So the definition is any trade or business where the principal asset of such trade or business is the reputation or skill of one or more of its employees or owners. And obviously accountants and CPAs and attorneys are included in that list, and we'll go into a little bit further list in a second. In the legislation, they specifically excluded architects and engineers, which was great to show some specifics, but they left out a whole lot of opportunities or a whole lot of possible professions that could be excluded. And based on that definition, the reputation or skill of one or more employees or owners, I thought real estate agents would be included in the targeted group of professions that would not be able to benefit from the 20% business deduction if your income was too high. And based on current literature and some guidance the IRS issued in the past couple weeks, real estate agents and real estate brokers are both excluded. So they're not part of the specified service trader business. And the reason for that is that they're seeing you as selling a product, a house or commercial real estate, or in other words, real estate in general, and therefore outside the scope of what would be considered a specified service trader business. So specifically, we now have bankers, engineers, architects, property managers, real estate agents, and brokers. And those entities, it's a good thing actually that you're not a specified service trader business, because that means you can make as much as you want and not have to worry about the tests, if you will, to determine whether or not you have made too much and therefore are either limited in the 20% deduction or maybe have been phased out of it. So the remaining specified service trades or businesses are areas such as health, law, accounting, actuarial sciences, performing arts, consulting, athletics, financial services, brokerage services, meaning stock brokers or other types of financial brokers, any trader business where the principal asset, such as a trader business, is the reputation, skill, or of one or more of its employees or owners. Any trader business that involves investing in investment management, trading, dealing in securities, and dealing in partnership interests or commodities. So on this webinar, obviously, we're talking about real estate agents. So it's a good thing that you're not in the specified service trader business group. It's one of the things that the FOMO does not apply. You're not missing out. So there's no fear of missing out. It's a good thing that you're not a specified service trader business. It means that you can earn as much as you want, or earn as much as you can, and still be able to get the 20% business deduction when your tax return is prepared. Essentially, that deduction is the lesser of 20% of your net business income. So that's a simplified explanation. 20% of your net business income, or 20% of your federal tax liability. It's computed without the 20% being included. Technical to get into over webinar. Maybe on the next one, I'll prepare a slide and show you how that calculation will work. That's the gist of it, though. For most of us, it's going to be the lesser of 20% of our net business income or 20% of our federal tax liability. If you have questions on that, please shoot them over to me, and we can go over those. I'm going to switch slides here and show you this particular document that I had typed up to reflect what a specified service trader business is. Like I said, it's a great thing for real estate agents that you're not included in this. It means that you can earn net income as much as you want and still benefit from the 20% deduction. Now, there are some other caveats that come into play with W-2 income, or W-2s paid out of the entity, and assets owned by the entity, which are way beyond the scope of today's conversation. But just know that your business is not in the specified service trader business category. And that question is going to come up probably more so next year, once people realize that they got the benefit of the 20% deduction or didn't, or it got phased out on their returns. That's the big thing that I wanted to cover today, in what I would start the conversation with today. And what I got wrong. Occasionally you get one wrong. And I was speculating. I assumed that because, in my opinion, real estate agents are relying on the reputation or skill of you, the real estate agent, that you would certainly fall into the specified service trader business category. It's one I'm happy to be wrong on. I'd rather have clients fall out of not being, or fall out of that category altogether, than be included in it, including myself. But I'm directly in the target of it. If you have any questions, let me know. I had trying to think what the interesting client conversation was this past week. It had to do with, and it was a real estate agent actually. I think it was because they are doing business in Kentucky and Indiana as well. They have a real estate license in Kentucky and a real estate license in Indiana, and one in Ohio. And they happen to be doing business as an LLC in the state of Ohio. Their entity, their LLC, is registered as an Ohio LLC. And when I found out that they are doing business in Kentucky and Indiana, I suggested that they talk to their attorney so that they can discuss whether or not they need to register their business entity in those other states, because their LLC is doing business in Kentucky and their LLC is doing business in Indiana. So when you're doing business in another state, you have to register as what's called a foreign entity. It's foreign. In other words, it's not an entity registered in their state. And in order to get the protections of the state, it needs to register there. So an Ohio LLC doing business in Kentucky would file a document with the Kentucky Secretary of State or the Indiana Secretary of State, or maybe the Florida Secretary of State for that matter, depending on where you're at, to let them know that your entity is doing business in their state. Yes, you may have a state income tax liability as a result of doing business there, which means the portion of your income that is derived from that other state would be taxable there. It would be a percentage of your net income that gets taxed there, not the gross, not the revenue. And it's based on essentially three factors. They call it apportioning: your revenue, your rent, and your wages apportioned to that state. And it's weighted between those three factors. I don't see it very often with real estate agents, but it is something that I know is an issue, or can be an issue, because I know real estate agents are operating as LLCs or S corporations. And I know there are agents that are registered in multiple locations. I have an agent who's registered in Ohio, Florida, Georgia, and Kentucky, I believe. This agent has changed residencies a couple different times to facilitate their lifestyle. And it's working out for them. But they will probably have to file in Ohio and Georgia for income that's derived by the LLC. Florida doesn't have a state income tax, so it doesn't come into play. I've got a couple questions here. Let me see what this one is. Different. What about doing business in different cities in communities of Cincinnati and Hamilton County? Well, as you know, Cincinnati is actually, I don't know the number. I probably ought to count them up someday. How many different taxing municipalities and villages are in what we would call the greater Cincinnati area? And that would encompass Cincinnati, Mariemont, Montgomery, Blue Ash, Sharonville, Deer Park, Terrace Park. Terrace Park doesn't have a city. Newtown, Cheviot. There's probably several in there that I'm skipping out on, just because I don't deal with them on a regular basis. Loveland comes to mind. There's a rule that if you're doing business in a city, that city wants a piece of your net income so they can have you pay tax on it. Generally, when an employee goes into a municipality other than where they work, let me back up a second. If you have a business in a city, let's say it's the city of Cincinnati, the net income or net profit of that business is going to be taxed by the federal government, the state of Ohio, as well as the city of Cincinnati, because you're doing business in that municipality. It's possible that you have employees who go into Blue Ash, for example, to do some work. The Ohio Municipal Code changed a couple of years ago, which now you can do that up to 20 times per year. So the Cincinnati business can send employees into the city of Blue Ash up to 20 times per year, and the employer does not need to worry about withholding taxes on their income or paying tax to that municipality. Once you go over that 20 days, it's retroactive to the first day. So all of your income from that second municipality, comes into the calculation for taxation there. Now you're only going to be taxed on the percentage of, essentially the percentage of your revenue, to keep it simple, that was earned in that second municipality, multiplied times your net income times their tax rate. And I don't know if I can find it real quick. I'll see if I can find it in a second. The slide that I had on this issue when I presented to a group of realtors a couple years ago. The thing about real estate agents is you may have a property for sale, and nowadays it hasn't been an issue the last couple of years because they're selling so quickly, but you could have a property for sale in a municipality that causes you to go in and out of that municipality on several occasions. Once you hit the 20, if you're an employee, you're subject to tax. The way the code is written, it's specific to employees. Now, I think it's being interpreted more loosely than that. In other words, if you're operating as a sole proprietor going into another municipality, I'm not sure that the 20 days is a fair measure. They may tax you right from day one. That's one of those things that it comes down to the how you define who is an employee. You're talking about a W-2 employee, or are you talking about the business owner themselves as far as a Schedule C? The problem that I see for real estate agents is you could have a property for sale in multiple, or properties for sale in multiple municipalities, and have a filing responsibility in all of those responsibilities depending on the circumstances. My suggestion is that agents track and know where their sales came from, what municipalities, but the administrative side of it gets to be burdensome. And I've told agents before, if I were a city tax administrator, one of the things I would do is on a regular basis drive around and look at whose signs are where, and every one of those agents at least gets a letter. Let them prove to me that they didn't have income in that municipality. I haven't seen that done. It's something that I think could be done. Give me a second, and I'm going to see if I can find the slide that I used to talk about this particular issue with real estate agents. I know there's one of my videos has it, but it's been a little while. Let's see. I think I've got it right here. I've got the MP4. I've got the video of it. Do I have the slide? I may have reused that slide too. Yeah, I'm not finding it right now. Essentially, I was showing the possibility of an agent reporting income in, I think it was up to 5 cities. It's not so much the tax that you might owe. The problem with the municipal reporting is that the tax itself may be very little, but it might be that you didn't file with that city because you didn't have a filing responsibility. So the penalty for not filing once they find out you were there is actually higher than the income tax. The income tax might be $10, $20, $30, but the penalty is $25 right off the top. So it's one of those things that we want to be aware of, but it can be incredibly difficult for an agent to track realistically, because it's difficult to. We can go back and create the records for it and file, and that's the most conservative thing to do. But it can, and then besides the penalty for not filing, you've got the cost of preparing the returns. So the cost of preparing a municipal return is going to be probably anywhere from $25 to $50 depending on where you go. So it's certainly not the tax that's the issue. It's the administration of the tax on the client side or on the taxpayer side. It's the taxpayer isn't necessarily going to know that a return needs to be filed. On our end, we may prepare a return for a client and we paper file all the municipal returns. So it might be we prepare the returns, but we don't really know that the client's going to file it or not. Now, and I do have clients, a couple of real estate agents who file in every municipality in which they sell a property. Like I said, that's the most conservative thing to do. And it might be something that I need to do a continuing education program on, and maybe have a tax administrator on to talk about it. And I think I'll do that. I'll make a note to contact one of the administrators who I speak with on a regular basis and see if I can have them sit in on a conversation with us. Any other questions? The question is, we need to send multiple tax returns for each. I I think what they're asking is we need to send multiple tax returns we need to send a tax return to each municipality, and there may be multiple municipalities. Yeah, that's possible. I mean, you could have a return for the city of Cincinnati, Montgomery, Blue Ash, Deer Park, Loveland, Mason. Each of those municipalities has their own income tax law. And if you're subject to that tax because you did business there, it's very, very possible you could have a tax return that needs to be filed for each one of those, all in the same year. It's possible. Like I said, I don't know how many municipalities are in what we would call the greater Cincinnati area, but there's probably at least 10 inside the 275 loop. 10 might be low. I'm not sure. One of you agents should probably know that. I'll find that out for the next call. I'm going to make a note here if I can find a pen. I'm going to see if I can get. I'm going to get a city administrator on the next call, or at least have them brief me on how they might treat a real estate agent. I'm not going to give anybody's name. That would be bad. But I will. I'll also find out if I can, or how as closely as I can, the number of municipalities within the 275 loop on the Ohio side. Kentucky's a little different. They have a license tax, and they may have a county tax and a city tax. So you may have 2 additional returns for every city that you're doing business in at Kentucky. Now, I don't think there are nearly as many municipalities inside the 275 loop in Kentucky as there are in Ohio. There's Covington, Fort Thomas, Fort Wright are the ones that jump up. Newport, but Covington, it actually goes way down into northern Kentucky, down past 275. And I don't know how large the other areas are, but those are the ones that jump out, those 4. And yeah, I agree. We are trying to avoid that. And we don't want to evade a tax. Evasion is bad. Evasion means that you've incurred the tax and now you're trying to do something to get out of it. And if the right thing or the correct thing to do is to file in a municipality, maybe you do a lot of business. Maybe you live in Westchester, but you do a lot of business in Sharonville. So maybe you just want to go ahead and file a Sharonville return because you know you're in and out of there a lot, and your income should be reported to that city. But the issue comes in when you're all over the place. You're in Sharonville, Blue Ash, Montgomery, City of Cincinnati, Deer Park, Mason, Loveland, and your activities are more spread out. So it becomes more of a challenge to stay up on all that. Now, it might be, as a safeguard, maybe what you do is file in the city with at least one of the cities and have that tax paid. And then if another city comes and says you owe us, you'd file a return with the original city for a refund. That way you've got some money paid in. I'm not saying that's the right thing to do. It's just an idea off the top of my head. I think the right thing for us to do is to talk to the city administrator for one of these cities and see if they'll come on. I think that would be a great thing. We can get them on and we can talk about how they look at real estate agents. And I'm not going to give you, like I said, anybody's name. Yeah, and my contact here says, yeah, that's me. I'm all over the city as well as northern Kentucky, and yeah, I know it's the government interference or the requirements of staying current with all of these different small taxing districts is difficult. One of the problems with the municipalities is that they're so close. Reading, forgot Reading. Reading is one that's fairly aggressive, in my opinion. They have, I have had clients in the past where I've prepared the return, given it to them, they've forgotten to file it, and a bench warrant gets issued by the city, which is not good. You know, if you happen to get a ticket for a stop sign or something and there's a bench warrant outstanding because you didn't file your tax return, makes for a bad day. So the cities are incredibly aggressive about going after tax revenue. The state of Ohio is aggressive about going after tax revenue. And the benefit that they have over the federal government is that they're right here. They can impact our lives very easily. They can put a lien on a vehicle or our house very easily. They can, like I said, get a bench warrant out for you. That's a like I said, that makes for a bad day. Don't want anybody to get arrested. Yeah, I agree. The comment is I don't really object to paying the tax, but it's so frustrating to keep up with all the rules and paperwork. And I agree, it's an administrative problem, and obviously you can pay somebody to do that, but to do the record keeping necessary to report to 15 different municipalities because you sold 15 properties in 15 different places, so different cities, it's difficult, even for someone on our side, because we don't necessarily know where a transaction occurred. So it might be something where we have to go back at the end of the year and rebuild it, or get the information every time a commission check comes in. We need to know, where was that check generated? Well, this half of this or 3/4 of this was Montgomery, and the other part was Blue Ash. And we have to record it that way and make sure we've got a record of where it was. It can be overburdensome, and especially if you're trying to do it yourself. The average real estate agent does not make a good tax preparer. I know that's a generalization, but it's my experience that you guys are great at sales and great at marketing and great at getting people to the table and to the closing. But most real estate agents' businesses fall apart after they get the check, and it makes the record keeping more difficult if you're not just tracking the federal rules, but now to get down into the weeds in the city rules. Most agents aren't going to do that unless they've got someone working on their behalf, tracking it as they go. I think it's bigger than that. The comment is, this seems like something the entire Cincinnati Area Board of Realtors should be aware of. I think the Ohio Board of Realtors is aware of it, and I would imagine the Cincinnati Board of Realtors is aware of it. I've talked to, when I presented to the group of agents a couple of years ago, Karen Schlosser was there, and we talked about it a little bit. And I think it's a bigger issue. It's not just Cincinnati; it's any metropolitan area in Ohio that has municipalities. Cincinnati, Dayton, Lima, Ohio, Toledo, Cleveland, Columbus. They all have suburbs, and each of those suburbs is, in many cases, maybe not in all cases, they're taxing municipalities. So Columbus has the same kind of issue. Dublin, Columbus itself, Greater Columbus. Dayton has Eaton and probably 2 or 3 other suburbs. Sylvania, it's Toledo. But I mean, Cleveland probably has as many as Cincinnati does, but it's a problem in the state of Ohio. And I don't know that that's ever going to get any better. It would take a significant change to merge, in my opinion, all those cities into one. And that's not likely to happen. You're not going to be able to get the city of Montgomery, the city of Blue Ash, the city of Sharonville to merge with the city of Cincinnati. And in between there, you have Newport. What am I thinking of? Can't think of a little city. To merge with, to create one big city. The residents of Montgomery want their own police force, their own their own schools. They don't want to share their resources with Blue Ash or Montgomery or, city of Cincinnati. They like it the way it is. It's going to be very difficult, if near impossible, to get all those cities to merge together. It might be something where, as an interim step, maybe the cities would agree that if you report your income to one city, you're good. But in the case of something like Cincinnati, okay, that law passes and you report all your income to Montgomery. That's 1%. Cincinnati's 2.1, so 1.1% of income to them has been missed. So they still want, they're not going to give that up. They still want that piece of your income. Yeah, I don't think most people necessarily object to paying tax as long as it's reasonable and not overbearing. It just happens that because of where we are and the number of municipalities that we have to deal with, that it can get to be unwieldy. I'm going to spend a second trying to find this slide if I can. Like I said, it's been 2 years or longer since I've done this presentation. That's too new. And I've changed the presentation over time. Let's see if this is the right one here. It's actually a spreadsheet that I had. Oh, here we go. I found the spreadsheet. Let me see if I can open this here. Yeah, okay. So this slide is a summary of what I used for the agents back in 2016. Now this is really outdated and somewhat incomplete. But what it would look like is, so let's say you have a real estate agent who had total commissions of $125,000. But 102 of it was not earned in a taxing municipality. 15 was earned in Montgomery, 5 in Blue Ash, and 3 in Mason. And these are the percentages of the total revenue that each of those categories represents. So Mason was 12% of the total revenue. So Mason gets 12% of the net income. So you take the total commissions minus their business expenses, things like auto expenses, E&O insurance, continuing education, all the costs of running their business to get to the $62,000. So each municipality wants a piece of that. So Montgomery, because it was 12% of revenue, gets 12% of the net income, which is $7,400 to the city of Montgomery, which means you owe Montgomery $74.40 for their 1% of the net income. Blue Ash, they had 4% of the revenue, so they get 4% of the net. We owe them $31. In total tax, it's $141 plus probably $75 minimum to do those returns, for the professional to do the returns. So the other slide that I have is, let's see if I can get to this. Now these, like I said, these are only if you are subject in a particular city, and that's something we'd have to explore. So this one is a little more in depth. Let me get it on my screen here. I'm gonna move it over. Do that. Yeah, here we go. On this one, we're looking at kind of the same thing. This is a high producing agent. They got $1.5 million or $1.9 million in revenue minus their expenses, net income $1.4 million. It doesn't really matter if you're a sole proprietor, a C corp, or an S corp. Montgomery revenue, Norwood, the percentage of the total, what's taxable to the city tax rate, what's due to the city. In this case, $1,600. An estimated cost to prepare the return. So the total cost of administering the city tax for this agent was $2,000. That's the tax plus the professional fees. No, Gary, in most cases, I'm guessing most professionals for a municipal return are going to be somewhere between $25 and $50. 75, it could be that high. Maybe you have some other things going on in a particular city. You have a couple of rental properties or something like that, along with your real estate business, your real estate agent business. But it is, I'd say 25 to 50 would be in that range somewhere. So those were presentations that doesn't even have the right logo on it anymore. These were done, like I said, in 2016, October of 16, I think. So that's something we'll explore on the next call. We'll talk about municipal taxes. I'll do some research. Like I said, I'll attempt to get a city tax administrator on with us and dig into some of the complexities of how they look at it. As I said, if I was a city administrator, I think it would be an easy revenue generator to send a letter to all the real estate agents that are selling property in my district or my city. Be a thorn in the side of the real estate agents, but and it would probably, some of them would probably reply and say they don't owe. We would just have to get verification. Or, I'm really speculating. I'm not a city administrator, so it's just something that is a possibility. It's out there. If you've got signs up, and nowadays signs are up and down pretty quick. But if you have signs up, somebody knows you're doing business there, and it's possible that they're making a list, and they may send a letter out. Hey, we saw you were doing business in our municipality. Do you owe us any money? And one of the things that, it would be tough for them to go to the county records to find out if you were the agent on a sale, but they could. Gosh, I don't know how they would do it. Send a letter to brokers in their municipality for a list of all the transactions that happened in the municipality, or the title companies. I don't know how they would drill it down to the agent. I guess they could send a bill to the broker, and then the broker would have to say, well, we commissioned that out to these various agents. You need to talk to them about part of it anyway, their portion of it. But it's something that's out there. It's certainly a possibility. Need to let you guys know that I will be on the radio this Saturday morning at 9:00 on the Rock and Roll Real Estate Hour with my buddy Gary Rosignol. We're on WDJO AM. I always forget the FM station nowadays. But it's always a good time, and Gary will have it on Facebook as well. If there's any other questions, let's see. No, I'm not running. Somebody says I won't vote for you as city admin. The FM station is 99.5 FM Saturday 9 to 5, or Saturday 9 to 5. There was a friend of mine up in Youngstown sent a picture. I think it was from him. His name, we call him Tony Loopholes. He sent a picture of a yard sign. It said Mike McCormick for sheriff. So now I'm the sheriff. My uncle ran for Indiana State House a few years ago, and I have a McCormick for state representative T-shirt, and I wear that to keep my neighbors on their toes. Well, I think we're going to call it a little early, unless there's a question out there. We will revisit the municipal tax issue. I'll dig into the details for you, and I'll see if I can. Pardon me. I'll see if I can get an administrator on with us. I think it would be worthwhile to get their perspective, and obviously we won't disclose any names. Hope to talk to you very soon. Have a wonderful Labor Day weekend, and I will talk to you soon. Look to see you next weekend or next month as well. What's the date of that? Let's see. It is going to be the last Wednesday. It'll be the 26th. September 26th will be our next webinar. Please let your colleagues and friends know. Bring their questions, and we will do our best to answer them, or at least have a spirited conversation, hopefully. Have a great Labor Day weekend. All my best. Take care. Thanks for coming.